Hello everyone and welcome back to the channel. So today's topic is something that I have been getting a lot of questions about lately. The question is this the right time to start investing in small cap stocks or mutual funds? Now, I do not want to give you just a one-line answer to this question and move on. That would be too easy and frankly too irresponsible, I think. What I want to do today is to give you the glimpse of my data as well. I will explain the patterns and then help you understand this question related to small cap stocks or mutual funds. I want to be careful here because when we deal with small caps, it is important that I should speak with clarity and responsibility. It is easy for me just to give my opinion, but I know that in times like these, responsible investing can be very profitable, especially in this small cap space. So let us get into it. What the long-term data actually tells us. Let's start with the big picture. If you look at the 10-year CAGR of the top small cap mutual funds in India, the numbers are genuinely impressive. Nippon India Small Cap Fund has delivered around 21.6% per annum over 10 years. Axis Small Cap Fund is about 19.3%. HDFC Small Cap is around 19% and Quant Small Cap is at 18.6%. And SBI Small Cap is at 18.8%. Even the more conservative funds in this category have delivered between 15% and 17% over 10 years. Now, let me put this in perspective for you. The average return across these top small cap funds is roughly 18% per annum over 10 years. What does 18% compounding mean in real life? If you have invested rupees 10,000 per month as an SIP 10 years ago, in a small cap fund, say like Nippon India Small Cap, your total invested amount would be around rupees 12 lakhs. And the current value of that investment would be somewhere in the range of rupees 36 lakhs. So you invested rupees 12 lakhs and your final value is about rupees 36 lakhs. This is roughly 3 times of your invested money. This is the potential of investing in small cap funds over long term. But what's more interesting is that 18% CAGR in 10 years is not the performance of some one lucky fund. It is a consistent pattern across the entire category of small cap direct plan schemes. My data shows that there were 13 number small cap direct plans that have been operating since last 10 years and 8 out of those 13 schemes generated a 10-year CAGR of 17% or more. If it is so, why are people worried right now? Let's talk about what is making people nervous now in 2026. If you look at the last 3 months, almost every small cap fund has given negative returns. The average 3-month return across funds is around -9%. The best performer in this short window is Union Small Cap Fund at around -5%. And some funds like Tata Small Cap and Helios are down around -12 to -13% in just 3 months. So yes, whoever recently started investing or is looking at their portfolio statements right now is seeing red numbers only. And that is uncomfortable. I fully understand that. And if you look at the 1-year returns, the picture is not comforting either. The average 1-year return across active small cap direct plans is around 6.5% per annum. That is barely above the fixed deposit interest rates. Some funds are doing better. DSP small cap is around 13%. Invesco and Mirai Asset are 11% to 15%. But several large funds like SBI small cap is only 2%. Kotak small cap is about 3% and Tata small cap is at -6.9%. So all of these known small cap players are looking quite poor on 1-year basis. So naturally people are asking, bhai kya ho gaya? Should I still be investing in small caps or not? Let me answer this properly so that it makes sense to you. Understanding the pattern of small cap funds, they are cyclical. I think this is the most important part of the video. So may I ask you to please pay attention here. Small cap funds have always been cyclical. What that means is they do not give steady steady linear returns. In some phases, the returns are very good, and in some cycles, like in last 3 months or last 1 year, the returns get very low or even negative. It is very important to understand this characteristic of small cap funds before investing in them. If you do not understand this, you will make the classic mistake. It will make you panic at the bottom and exit at exactly the wrong time. Let me show you what I mean. I will be using the actual mutual fund data. Look at the year 2017. This is almost 8-9 years back data. The top small cap fund gave anywhere from 40 to 80% return in a single year in 2017. Nippon was up 65%, SBI small cap was up 80%, HDFC was up 63%. Then came year 2018. The same funds fell sharply. The average return across top small cap funds was around minus 13% in 2018. DSP fell by 25%, SBI fell by 18.5%, Nippon fell by 15.6%. People who had invested in 2017 were sitting on big losses by the end of 2018. Then year 2019 was also a weak year. Even in 2019, it was a flat to slightly negative returns for most small cap funds. Then came 2020 and the market first crashed badly due to COVID. And then the recovery started. Small cap funds recovered sharply in the second half of 2020. Funds like Quant were up 76% in 2020. Nippon was up 30%. SBI was up 35%. Then year 2021 was again an extraordinary year for small cap funds. Almost every small cap fund gave between 49 and 91% returns in a single year in 2021. The average across the top 10 funds was around 67% in year 2021. Quant small cap alone gave 91.7% in year 2021. These are absolutely extraordinary numbers. There is no doubt about it. Then 2022 was again a flat to sideways year. Most small cap funds gave minus 2% to plus 11% returns in year 2022. The year 2023 was a massive bull run again. Nippon was up 50%, DSP was up 42%, HDFC was up 46%, Bandhan was up 56%. And 2024 was also good, where most funds delivered between 20 to 45% returns. And then came year 2025 and now we are in 2026. These 2 years are again looking weak so far. There is negative 1% to negative 4% for most top small cap funds. And the broader 3-month number is consistently in red, as we have discussed earlier. So the pattern is clear. Small caps have a rhythm of strong years followed by consolidation or deep correction phases. And what we are in right now in 2026 is a consolidation or a correction phase. So the question is this the reason to be scared, or is this actually an opportunity for investing in small cap funds? What history tells us about investing during corrections? Every major correction in small cap funds, and we have seen there has been several in the past, like in year 2008, in 2011, in 2018, and in the 2020 COVID crash. So after every major correction in small cap funds is followed by a very sharp recovery. And in every case, the people who continued their SIPs during the down phase or even added a lump sum money during the low phase ended up generating exceptional returns for their small cap basket. Let's look at the data again. The people who were investing in small cap funds in 2018 and 2019, when these funds were delivering negative returns and everyone was saying small caps are finished, those same funds went on to give 49 to 91% returns in 2021 and 42 to 56% in 2023. That is the pattern about small cap funds that we must always keep in mind. The correction is what creates the opportunity in the small cap space. In corrections, we are essentially buying good quality small cap stocks at cheaper prices. This is the main goal of all long-term stock investors, right? We must get the opportunity to buy quality stocks when their prices are very low. But I want to make this also clear that I am not forecasting that markets will bottom out tomorrow in 2026. A lot of quality small cap stocks have already corrected a lot. This is true. But this is also possible that a deeper correction will come in next few weeks or months. Nobody knows if the small cap index has already bottomed or not. What I am saying is, if you are a long-term investor with a 5 to 7 years horizon, the current situation is more of a buying opportunity than a reason to stop investing. This is my simple point. In fact, this logic is true for all mutual fund categories. But from the data that I have shared with you, it is clear that the small cap rebound upwards is much faster than other class of mutual funds. But not every small cap fund is worth investing in. And this is where I want you to be very careful. This point is very important. Not every small cap fund deserves your money. Let me explain why I am saying so. When I look at the data, I see a clear pattern of quality separation across funds over a full cycle. For example, Nippon India Small Cap Fund is the largest in this category with an AUM of 67,600 crores. Its 10-year CAGR is 21.6%, its 5-year CAGR is 21.3%, and its 3-year CAGR is 19.6%. Even in the current tough phase, its 1-year return is plus 7.85%, which is a decent given the kind of environment we are in. This fund has consistently compounded well across multiple cycles. Its expense ratio is also low at 0.65% for direct plans and for 1.4% for regular plans. Similarly, Quant Small Cap Fund has the best 5 years CAGR in the category at 23.9%, and its 3-year CAGR is also 18.4%. But it is also one of the most volatile funds. It was down 23% in 2019. So funds like Quant can reward you very well, but it will also demand a lot of your patience in a falling market. Quant's expense ratio is 0.8% for direct plans and 1.64% for regular plans. Similarly, Bandhan Small Cap Fund is a relatively newer fund but has delivered 29% 3-year CAGR and 22.3% 5-year CAGR. These are very strong numbers. The expense ratio of this fund is also low at 0.48% for direct plans and 1.62% for regular plans. This is the performance of some known quality small cap mutual fund schemes. Now on the other hand, if you look at funds like Aditya Birla Sun Life Small Cap, its 10-year CAGR is only 14% and its 5-year CAGR is modest at 13.5%. This is significantly below the category average, right? So we can say that as compared to peers, this particular fund has historically underperformed. Similarly, some newer funds have very limited track record and should be approached with more caution. So the message here is this: not all small cap funds are equal. So our focus should be to invest in quality funds with strong track record across multiple market cycles. What makes more sense right now, SIP or lump sum investing? My view is this: if you are a salaried person or someone who does not have a large lump sum money sitting idle, then SIP is the right approach for sure. Continue your monthly SIP. In fact, if you can, increase your SIP slightly during this correction phase. If you do have a lump sum that you want to deploy, then I would suggest this is the time to put those lump sum money to work in equity. Use these funds gradually to accumulate small cap fund every time the NAV falls. But remember this: avoid putting all your lump sum money in one shot right now. I am not saying this because small cap will definitely fall further, but I'm saying this because the uncertainty is still there. In case the NAV falls more, you should have some money left with you to buy more at lower prices. In such markets, being disciplined is more important than being aggressive. what is a realistic expectation going forward? This is an important thing to address in this video because I think some people have unrealistic expectations from their small cap funds. To tune your expectations, let's look at 3-year CAGR numbers. The average across quality small cap fund is about 18% per annum. The 5-year average is around again 18% per annum. The 10-year average is about 17.7% per annum. So over time, if you stay invested in a good small cap fund, you can realistically expect somewhere between 15% to 20% CAGR over a 5 to 7 year horizon. But, and this is a very important but, this return will not come in a straight line. There will be years where you will get 50 to 60% returns, and then there will be years where your portfolio will show minus 10% or even minus 20% returns. You have to be mentally prepared for both fantastic numbers and deep red numbers. The people who get the full benefit of these funds are those who stay invested through the entire cycle. This cycle of NAV falling and recovering can happen multiple times in a 5 to 10 year time horizon. We must always remember this. The return will not be linear of 18% per annum, but it will be hugely cyclical. This is a very important understanding about small cap funds. So if someone asks me, should I expect 18% every year? The answer is a big no. Why? Because you should expect 18% on average over a long term. It means if you stay invested for 5 to 10 years, only then you will get a desired 18% CAGR from your small cap funds. But this is also true that you will also see a lot of volatility in between. So is this the right time to invest? Based on everything I have shared with you today, here is my honest view. Yes, for a long-term investor, this is actually a reasonable good time to start or continue investing in quality small cap funds. However, let me tell you what to be careful about. Point number 1, invest only that money in small cap funds that you can allow to stay invested for next 5 to 7 years. Point number 2, keep your small cap allocation reasonable. Small cap should not be your entire portfolio. If your portfolio is 100%, keep a 20% limit to small caps. Point number 3, choose a fund with a strong track record. At least 5 to 7 years of data should be there to prove its worth. These funds should have operated through multiple cycles. Then only you can rely on a small cap fund. Thank you for watching. See you in the next video.